Hello everyone and welcome to the very first episode in a new series called DIY Investing Education. So the plan is to have over 20 episodes for this educational series where my intention is for you to learn all the core basic concepts of investing. We're going to talk about, terminologies, accounts, indexes. We're really going to learn the basics for what you really need to start investing on your own. So these could be great reminders if you're already a DIY investor. But if you have friends or family that don't really know much about investing or thinking about investing on their own, this is a great video to send them because there's going to be a playlist so they could watch episode after episode after episode. And we're going to start with what I feel is probably one of the most important things to learn and understand as an investor, to know what it's about, the S&P 500 index. I'm sure you heard about it before in the news, right? The S&P 500 index. What is this? What does it mean? Let's get into it, and I'll show you a bunch of examples, and we're going to dig deep a little bit into this because the initial definition terminology might confuse you a little bit, but nonetheless, we'll start with that on Investopedia. So the S&P 500, the S and the P stands for Standard & Poor's, which is a credit rating agency, is a market capitalization weighted index or a market cap weighted index of 500 leading publicly traded companies in the US. So it's not exactly a list of the top, let's say 500 US companies by market cap, which means market cap means, the bigger the market cap, the bigger the market capitalization, the bigger the company is worth. So for example, Apple is currently the US company with the biggest market cap right now as I'm filming this on April the 21st, 2025. There's also other criterias, but the S&P 500 index, or the S&P, is nonetheless regarded as one of the best gauges of prominent American equities performance. Equities mean stocks, and the stock market overall. We've all heard the expression, the market, how is the market doing, beating the market, underperforming the market. Well, the S&P 500 sometimes is pretty much that. That's what people are talking about when they say the market, because it's so diversified. It really is, like it says here, a good gauge, the overall American stock market. So the key takeaways, like we said in the definition, 500 leading US publicly traded companies with a primary emphasis on market capitalization. We'll see the top 10, but this basically means that the bigger the company is, the bigger percentage it's going to make up of the index. It was launched in 1957. This index was launched in 1957 by Standard & Poor's. It's considered one of the best gauges of U.S. large cap stocks and even the entire stock market because of its depth and its diversification. We'll see that in a second. You can't really directly invest in an index, an S&P 500 index, but you can invest in many funds and ETFs that use it as a benchmark, that are trying to replicate the S&P 500 index. And by the way, if you're curious, if you like Google, you could just Google SPX. That is kind of like the code for the S&P 500 index. This is really the graph of the index for the last, just under 30 years, since 1996 until now. April 21st, 2025. So you could see that over the long term, this index has done really well, right? We know that the stock market tends to go up over the long term, but of course it has its dips, like the 2000s here, like 2008, like COVID 2020, and like actually some volatility that we're going through now. But over time, it tends to be, a very, very good investment. So now for some more practical knowledge, we've discussed that you can't really invest in the index, but you could invest in an investment vehicle that mimics or tracks or tries to track the index. The oldest and most popular one is the SPY ETF in the US. So sometimes you might actually hear that, the SPY, right? They're actually referring to an ETF trust from SPDR, sometimes also known as SPDR. It's really State Street Global Advisors. That's the company who manages this ETF trust. So the stock symbol is actually SPY, and it tries to replicate the S&P 500. This actually came out, I believe, in 1993. There it is. It's one of the oldest, if not the oldest, S&P 500 ETF trust. So it's been around for a really, really long time. So when you're investing in, let's say, an ETF or something like this that is trying to track the S&P 500, what companies are you actually investing in? Well, if you go to holdings, you'll actually see the top 10 stocks. A lot of you, if you're all going to recognize a lot of these companies. We've all heard of them. So here are the top 10 fund holdings. You have Apple, which is the biggest at 6.67%. Microsoft, Nvidia, you have Amazon, Meta, right? Formerly Facebook, Berkshire Hathaway, which is Warren Buffett's company. You have Alphabet, which is Google, Broadcom, another Alphabet listing. And this is where, like we read before, it could have 503 constituents because some companies have two classes of shares. Alphabet, aka Google, is a perfect example. They actually have two classes of shares right here in the top 10. So if you add them up, it makes about 3 point something percent. And then you have Tesla at 1.52. So if you add them all up, these 10 stocks or 9 companies actually makes up about a third of the S&P 500. So even though there's 500 companies technically, the top 9 make up a third. And this is because the bigger the market cap or the bigger the company is, the bigger share it will have of the index. And this is another important point. Because it's an index, it's always changing, right? Because the values of companies are always changing. So let's say Apple and Microsoft, start going down over time. Well, they're going to have a smaller percentage. And let's say another company starts getting bigger and bigger over time, it's going to have a bigger percentage. So an index type ETF or an index style ETF is always changing, right? So this is like automatically rebalancing the portfolio of the 500 stocks to really give you access to the top companies all the time, right? In terms of percentage, which is really, really cool because it really technically means you don't really need to babysit. This is a self-adjusting benchmark or index based on the market cap, based on how big the company is. And if you look at the sector, now this is you hear the term diversification a lot, and we're going to dig deep into it in another episode, but you basically have all 11 stock market sectors represented in the S&P 500, and you have it here. So about 30% right now, 29.45 is technology stocks, 14.59 in financial stocks like banks and credit card companies, 11% in healthcare, communication services or telecom, consumer staples, etc., etc. So you actually have all 11 sectors of the stock market represented in the S&P 500 index. So this is, that's why they say it's very well diversified. And if you look at the performance in the, since January 22nd in 1993 until the end of March of 2025, the average annual performance, so the average per year, is over 10% per year. So this is a really good and consistent performance over time that this index has. So hopefully you've learned really and seen what the S&P 500 is. Now in Canada, if you're Canadian, there's many Canadian listed S&P 500 ETFs. Some of them are different styles, but let's just go through two very popular ones by Global X Investments Canada. So these you could buy and sell, by the way, in Canadian dollars. These are listed on the Canadian stock market, and the dead giveaway is really the name. You see the Global X S&P 500 Index ETF. So the stock symbol is USSX, and this ETF is trying to replicate the S&P 500. So it's like an easy way or a very convenient investment vehicle to invest in the S&P 500. So this is really for growth investors that want that performance of the S&P 500 over time. Here's another one that's actually an S&P 500 covered call ETF. So this is more for income-oriented investors. Stock symbol is USCC, and you could see that as of April 17th, it actually has an annual distribution yield of over 12%. So this is really, you're still investing in the S&P 500, but there's a covered call strategy on top of it, which I'm going to cover in a future episode to tell you all about what covered call strategy is, giving you consistent monthly income. And there's Global X Canada actually has more S&P 500 style ETFs. I'll put them in the links in the video description below. So hopefully now you have when people say the market, or sometimes it's just nicknamed the S&P or the S&P 500 index, you know exactly what we're talking about. It's really 500 leading US publicly traded companies, with the biggest ones, right, the bigger companies making up the biggest percentage. So it's a great way to really think of the entire US stock market. It's diversified. It has a bit of everything in terms of sector. Definitely more skewed towards technology these days because, Apple, Microsoft, and those technology companies are really the biggest companies right now. But again, the sectors could always change because this is an index that's always rebalanced by Standard and Poor's to give you really the top exposure to the top 500 publicly listed companies in the US. So very, very convenient to kind of like buy the market or invest in the entire US market. So hit that thumbs up button if you learned something. I would really appreciate it. And don't forget to send this video to someone else, to a friend, to a family member who's thinking about investing, because these are very, very important core concepts to understand. And see you in the next episode.